Everyone owes money. So who gets it?
Global debt has surged beyond $315 trillion, nearly triple the size of the world economy.
From America's 38 trillion to Europe's 14 and Japan's 9, debt has become a universal condition.
But when every nation on Earth's drowning in debt, a deeper question emerges. Who is the creditor?
England's war with France strained its treasury, revealing a new problem. Military power now required financial innovation. This document marked a revolution, a promise that could be traded, bought, and sold. The government bond.
France copied the system. The Netherlands refined it. Soon, national debt became the backbone of state power.
The assumption of state debts is essential for the stabilization of our union.
But the consolidation of power through taxation will burden the common farmer.
By 1694, England's gold was nearly gone, forcing the Crown to seek a new source of wartime financing.
Merchants agreed to fund the war, accepting government promises in exchange for future interest backed by taxes.
To manage this new arrangement, England created the Bank of England, an institution built on organized public debt.
National debt became a marker of credibility, proof a state could borrow, invest, and command financial trust.
Empires once conquered territory for gold. Now they issued bonds, shifting conflict from land to balance sheet.
Centuries later, debt became the world's dominant export, fueling growth, stability, and every modern financial system. The United States now carries over $38 trillion in federal debt, the largest figure in history.
Europe carries 14 trillion in debt, Japan nearly 9, proving no advanced economy escapes borrowing.
Even oil-rich nations and export giants owe huge sums, revealing debt as a universal economic foundation. Much of America's debt is owed to America itself, creating a circular balance where liabilities become assets.
Foreign lenders hold about $9 trillion in U.S. debt, led by Japan and China, though they remain minority holders.
Japan lends to the U.S. lends to Europe, Europe lends to developing states, forming a global circle of credit.
Every IOU is held by another IOU, creating a chain where debt simply rotates instead of disappearing.
Behind governments stand markets, deciding who borrows cheaply and who must pay a premium to survive. Central banks manage debt by creating money to purchase bonds, transforming obligations into assets instantly. Every physical and digital dollar represents debt somewhere else, binding money and borrowing together. The system works because investors believe debts will be serviced, even if the principal is never repaid.
Governments continually issue new bonds to pay off old ones, creating an intentional cycle of refinancing.
Like a shark that must keep moving to breathe, modern economies survive only if debt continues circulating. Paying off all government debt would collapse collateral markets, removing the foundation of global finance. Interest payments rise from taxpayers toward institutions, creating an upward transfer embedded in the system.
Debt moves money upward, not evenly across society, linking inequality to the structure of credit itself.
If every country owes money, the question returns with greater force. Who ultimately receives the payments?
Most governments owe first to their own banks, the institutions that buy debt not as charity, but as their safest and most reliable asset.
Every citizen with a pension or retirement fund is a quiet creditor, earning interest from the same government they also owe taxes to.
Central banks are not just managers of debt. They are its ultimate custodians, holding bonds that anchor entire currencies in place.
Foreign governments also buy U.S. and European debt, but their role is secondary compared to domestic banks and pension funds.
Oil economies reinvest petrodollars back into Western bonds, making exporters creditors of the same nations they supply.
Mutual and index funds hold sovereign bonds not as ideology, but because nothing offers steadier, quieter returns.
Insurance firms invest premiums in government bonds, so future losses stay funded by stability.
not speculation. Institutions like the IMF step in only when confidence breaks and debts stop rolling on their own momentum. When rates rise and liquidity thins, creditors become visible, and debt stops being silent architecture.
The world owes itself, but the returns flow upward to those who hold debt not as burden, but as quiet income.
Banks hold sovereign debt not as risk, but as foundation, quietly lending nations their own stability back.
Retirement systems invest in government bonds, making workers lenders to the same state they fund through tax.
Central banks absorb debt so markets keep breathing, anchoring currencies with quiet promises of repayment. Foreign governments hold debt too, but only after domestic institutions have already secured their share. Oil revenues flow back into Western debt, turning exporters into creditor of the markets they fuel. Index funds buy sovereign debt for the same reason the world trusts it. Nothing else holds steadier over decades.
Insurance firms depend on sovereign bonds to honor claims not today, but decades from now. Only when markets hesitate do global institutions step forward to steady the debt cycle.
When liquidity thins, the invisible creditor network becomes painfully clear. Debt flows downward, but interest flows upward to the holders who never need repayment, only renewal.
Credit ratings decide how expensive debt becomes, shaping national futures with one incremental change in confidence.
As the world's reserve, the dollar turns America into borrower and banker, debtor and creditor at once. China holds U.S. debt, not to control America, but to stabilize its own vast export-driven reserves. Clearinghouses ensure lenders and borrowers meet, letting debt circulate like a global bloodstream. Japan remains America's largest foreign creditor, holding debt not as leverage, but as lifeline for its savings system. Europe purchases American and Asian debt alike, binding continents through paper, not conquest. Sovereign debt becomes crisis only when markets doubt that tomorrow will fund today's promise. Debt is never retired. It is renewed, extended, and refinanced until payment becomes abstraction. The world owes itself, but the returns pool upward into institutions built to never retire their claims.
In the end, debt belongs to the holders, not the issuers, those who never demand repayment, only continuity.
U.S. Treasuries form the backbone of world credit, the asset everyone trusts when nothing else holds.
The dollar matters least as cash, and most as the world's preferred collateral, reliable when confidence thins. If America cleared its debt, the world would lose its safest collateral, and the markets built on it. With over 20 trillion in circulation, treasuries are the scale that keeps global credit from collapsing inward.
In financial storms, capital runs not to gold, but to treasuries, the modern sanctuary asset. Treasuries must grow as global finance grows. The asset expands to match the world it steadies.
Treasuries calm markets, not through payment, but through certainty that payment will never be demanded.
In panic, markets retreat to U.S. debt, not for return.
Banks use treasuries as collateral to borrow more, creating a loop, not of debt, but of trust.
Every financial system leans on treasuries, because every economy needs something that does not break.
Above sovereign debt sits a taller structure, derivatives that amplify debt into the world's quietest leverage. Banks borrow against bonds, then lend again, stacking leverage on instruments designed to feel riskless. Interest rate swaps hedge risk, yet quietly link nations in a deeper chain of mutual obligation. Repo markets recycle bonds nightly, letting debt act as perpetual motion, always borrowed, never resting. Derivatives don't create wealth, They multiply confidence, leveraging a promise into many more promises. In this shadow layer, debt becomes abstraction, still anchored by treasuries, yet multiplied in silence.
Synthetic products mirror real bonds, turning one piece of collateral into many forms of liquidity.
Derivatives cushion shocks until they fail, hiding disruption beneath engineered stability.
Banks pledge treasuries again and again, borrowing the same safety more than once.
At the top sit derivatives, but beneath every layer lies one instrument.
Debt becomes crisis not at issuance, but when belief wavers and refinancing no longer feels routine. In Greece, doubt raised rates overnight, proving debt depends less on numbers than on confidence. Argentina's defaults reveal less a failure, more a rhythm, debt breaking, then returning with new terms. Austerity did not punish Greece. It recalibrated markets so lending could resume on steadier terms.
Sri Lanka faltered when reserves ended, reminding markets that debt relies on currency, not courage.
Crisis begins not in headlines, but when liquidity dries and rollover shifts from routine to impossible.
Lebanon's collapse showed that pegged currency cannot hold if reserves evaporate faster than trust.
Bailouts are bridges, not cures, built so markets can cross uncertainty without drowning in it.
Debt crisis ends not with repayment, but with belief returning just enough for lending to resume.
Currency strain pushed Turkey into emergency rates, proving debt depends on faith in tomorrow's tender.
Interest moves wealth upward, drawing earnings from many into quiet reserves held by few.
From households to funds, payments climb until they settle in portfolios built to never withdraw. Inequality is not commanded. It is engineered by interest flowing along the paths finance built.
Pension beneficiaries profit from debt, transforming workers into indirect creditors of their own governments. Wealth doesn't gather by intent, but by gravity, flowing to where bonds and interest already reside. The true creditors are pools of capital, not personalities, institutions that outlive every administration. Index funds accumulate debt automatically, turning passive savers into silent global creditors.
Interest travels upward silently, never seen, always settled, before the public even registers movement.
The world owes itself, but not evenly. The reflection shines brighter where debt is owned, not owed. The system isn't cruel, only consistent. Interest rises because the architecture directs it upward. Debt functions because it is systemic, not narrative, an operating layer beneath politics, trade, and currency. Sovereign debt forms a closed circuit. Lenders and borrowers mirror each other within one balance sheet. There is no external creditor. The system owes internally to itself across institutions and reserves.
Governments issue debt and then hold each other's, erasing any clean line between borrower and creditor.
Sovereign debt is not designed for elimination. Rollover is its operational mode, not exception. Central banks stabilize markets by holding debt as base collateral for all other lending.
Debt is not a threat, but infrastructure, the shared platform upon which global liquidity runs.
Funds maintain systemic balance by diversifying debt holdings across regions without changing total exposure. Globally, debt is both liability and asset. Removal of one destabilizes the other. In final accounting, the world owes its debt to itself across holders, banks, and reserves.
Despite appearances, the debt system has no outside lender. All claims remain internal to global balance sheets.
Settlements clear in continuous rotation, keeping sovereign debt functional rather than terminable.
Sovereign issues do not retire. They remain core collateral anchoring all other credit.
The global debt network converges, making creditor and issuer distinctions structurally interchangeable.
Repayment is not the purpose. Continuation maintains liquidity and pricing stability. Obligations persist by design. Expiration is theoretical, not operational. Macro balance depends on uninterrupted issuance. Reduction destabilizes collateral supply. All sovereign systems rest on three aligned components: currency, credit, and collateral. Aggregate global debt nets internally. There is no leftover creditor outside the system. Sovereign debt, in final terms, is an internal claim system with no external creditor. If every country is in debt, who are the creditors?
No one outside the system. The world owes itself.